Okay, chapter 19, and this and chapter 22 are the last two chapters in the book that we're going to go over. 2 chapters left. This calls for a party, right? Let's go to a lot of turkey rounds again this one. So, federal taxation of real property, income taxation specifically. And what are the benefits, what are the downsides of owning property? There's going to be some math involved here, don't worry. It's not overly difficult math. It's just some math involved with taxation questions. But there's not a ton of stuff here, right? So the first thing you need to know is that certain expenses that are associated with making your monthly loan payment are tax deductible, okay? And when I say tax deductible, I mean on your annual income taxes. When you do your annual federal income taxes, we're not talking about state law here, we're talking about federal law. When you do your annual income taxes, there are certain advantages to home ownership, things that are tax deductible. Some of the costs associated with owning a property are deductions on your income taxes, and they list them on page 429. And we've got them right here on the slide as well. The first of them, mortgage interest on first and second homes. So any interest that you pay on your first or second home is going to be a tax deduction. Not your entire payment, but the interest portion of your payment is going to be a tax deduction on your annual income taxes. So if you pay $7,000 in interest, which is easily possible, $10,000 in interest, that's a tax deduction that you'll be able to take when you file your federal income taxes.
And that's on both, like if you have two on the one house.
Yes, yes, absolutely, absolutely. As long as it's on your first and second homes.
Per year?
Every year.
So first and second purchase, so if you're an investor, first 2 purchases.
No. Home, there's a specific definition of home.
Okay.
You know, you can have up to 2 primary residences at any one time,
Yeah.
and those 2 are the ones that you're allowed to take these deductions on. Okay? And that can save you, depending on what tax bracket you're in, $10,000 in interest, which, that's a $1,300 house payment. That's not a huge house payment. Could save you $2,000, $3,000 in actual taxes that you have to pay. So it can add up fairly quickly. That is an ongoing deduction. That means you can take that deduction every single year. Now keep in mind it should be a smaller deduction every single year because in theory your loan balance is coming down, therefore your interest is coming down. If you've got a 30-year fixed loan, then the interest is going to decline every year, so your tax deduction is going to get lower every year. In the year that you buy, your loan discount points are tax deductible because the government views those as prepaid interest. It's interest that you're paying in advance. Remember you pay discount points to lower your interest rate? Well, the government just views that as prepaid interest. So you get to deduct those in the year that you purchase. Okay. Prepayment penalties, which hardly ever happen anymore, are tax deductible. And it says some loan origination fees, if they're quoted as a percent of the loan amount, and if paid to obtain the loan. Those are also tax deductible. So usually your origination fees are going to be tax deductible. And that's, of course, in the year you get the loan. The year you purchase the property. The year you get the loan. The only one that's an ongoing every year is the interest. One additional one, this is a change in recent years, your mortgage insurance is also tax deductible now. Federally, yes. Yep. Another ongoing tax deduction that you get every year, and I love the last bullet on the slide. We teach you all this stuff and say, by the way, you should never tell anybody any of this. You're not supposed to give tax advice. Your real property taxes on a yearly basis are tax deductible expense. So that's another yearly deduction you're going to get on taxes. the whole amount of your property taxes, which will generally be much smaller than the interest that you're deducting, but it adds to it, it adds up. And this is one of the things, so even though you should never give tax advice, I'm going to point out to you why you should understand the way this works. Lots of times you'll have first-time home buyers and they're making direct comparisons between, what they rent for now and what their house payment will be, which is a smart comparison to make because that's what they can afford on a monthly basis. But it is worthwhile to point out to them that if you can find something where the payments are the same, you're actually saving a tremendous amount of money, because at the end of the year, they're going to save several $1,000s in income tax as an owner versus being a renter. So while on a monthly basis their payment may be the same, you're going to get a tax refund or a lessened tax bill at the end of the year if you are an owner versus a renter. So it is worthwhile to know this, to point it out to people. I don't recommend you put people in something that's a higher payment and say, oh, well, that's because you're going to be saving this at the end of the year, because they probably won't be able to afford it monthly, and that kind of defeats the purpose. Okay? There are also tax benefits, in addition to tax benefits of owning property and owning a residence. There are tax benefits to selling a residence of yours. If you have a property that is your primary or principal residence, there are benefits to that. So let's talk about something called capital gains. Let's talk about a capital gain. A capital gain is a profit you make when you buy something and then you sell it down the road later on. Stocks. You buy them at one price, you sell them at a higher price, that's a capital gain. Homes. You buy them at one price, if you sell them for more down the road, that difference is a capital gain. Usually what do you do when you have gains in this country, or profit? What do you do? You pay taxes on the gain, right? Taxes on the profit, taxes on your income. I'm sorry?
Unless it's IRA pre-tax.
Well, unless it's something that's pre-tax, and even then you pay taxes when you take it out, if you take it out later, exactly. At some point they're going to get it, right? Except your primary residence. They never get it. The sale of your primary residence, unless, and we're going to talk about yes, you could pay some taxes on the sale of a primary residence, but you'd have to be making a hell of a lot of money for that to be the case. For the most part, for most of you, you will never pay any federal taxes on a gain on your primary residence. Okay? And we're going to talk about the specifics of that exemption and what the numbers are. But for most of you, you will never pay any taxes on the gain you achieve when you sell your primary residence. And you can do that every 2 years. 100% tax free.
So even if you sell your primary residence 1 year, you have another one, the second year you sell it, you don't get it that time.
Right, you have to wait at least 2 years. You have to wait at least 2 years. Okay? So let's talk about the difference between a short-term capital gain and a long-term capital gain. This is really hard. If you own the thing that you just sold for less than a year, it's a short-term capital gain. If you owned the thing that you just sold for more than a year, it's a long-term capital gain. And these things have different tax rates associated with them. Remember, the only time we're talking about gains is when we sell, right? You can't have a gain unless you have a sale. It's not possible. If I've owned the property for less than a year and I sell it and I make a profit on it, that's called a short-term capital gain. The government treats that just like any other income I make. That means they're going to tax it at a rate that's equal to my tax rate, whatever tax bracket I'm in, whatever tax bracket I have. If I'm in a 25% tax bracket, I will pay 25% taxes on that gain. That's for short-term capital gains. Okay? There's no magic number there because everybody is in a different tax bracket. Is everybody with me on that so far? That's short-term capital gains. Long-term capital gains have a set tax rate and have since Ronald Reagan's second year in the White House, 1981, I believe.
May change soon.
I'm sorry?
May change soon.
They'll never, I just can't, I cannot see them. They may raise the capital gains tax rate, but I cannot see them going back to ordinary income tax rates on it. They may raise it to 20% or something like that, but, so the rate for long-term capital gains is 15%. Doesn't matter what tax bracket you're in, doesn't matter anything about your income level. If it's a long-term capital gain, it is taxed at 15%. And you need to know that rate because you may get a math problem and they'll want to know how much capital gains tax is due. And it's always going to be 50. If it's a long-term gain, first of all, you'll never get a math problem where they want to know how much the tax is due if it's a short term, because you can't know. You don't know what the tax rate is, right? So if you get one of these, it's always going to be long-term capital gains tax rate problem. So it's always going to be 15%. Here's where they're jerks. Ann is in a 35% tax bracket because, you know, Ann makes like at least $300,000 a year, right? She's up there. She's a hoity-toity, the cream of the crop.
Take care of my kids.
Yeah. Ann is in a 35% tax bracket and sells a property that she's owned for the last 6 years and has a capital gain, blah, 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 blah. So she has this $100,000 capital gain on it. What rate is that capital gain going to be taxed at? 15%. So they're going to throw that 35% in there on purpose and hope you'll use it. Long-term capital gains, always at 15%.
1 year more.
1 year or more. If you've owned it for a year or more, it's always at 15%. So let's talk about how you calculate a gain. What is actually a gain? Because it's not just as simple. It's not, thankfully. Trust me, you don't want it to be simple when it comes to paying a tax. It's not as simple as saying what I paid for it minus what I sold it for minus what I paid for it. That would be easier from a math standpoint, but you pay a lot more in taxes that way. Okay? The formula is actually going to be something called, for a capital gain, I want you to write this down. The formula is actually going to be something called the amount realized minus the adjusted basis. The amount realized minus the adjusted basis. And here's my little reminders to myself. I sold, what I bought. So it's the amount I paid when I sold, or amount I got when I sold, minus the amount I paid when I bought. That's the formula to calculate a capital gain. Is everybody with me on that? So this minus this equals capital gain. And if it's a long-term capital gain, how would you figure out the tax from that point? You'll multiply that number times 15%, and that would equal the capital gains tax paid on that transaction. Yes, sir.
Is it the same if you have, let's say, a short sale, where you're forgiven,
Yes.
you're forgiven, but you get 1099?
You're gonna get 1099, and so that's gonna get figured into it. Yes. Yes. Does everybody understand this basic formula? Because you need to understand how to get to a capital gain and how to get to a capital gains tax. We're going to talk about what amount realized means and what goes into that. We're going to talk about what adjusted basis means. But I want you to understand this very basic formula. Amount realized, what I got when I sold, minus adjusted basis, what I paid when I bought, is equal to my capital gain on the property. And that capital gain times 15%, assuming it's a long term, which it will be in a math problem, is going to be the tax that I pay on that gain. Does everybody with that basic math equation so far. Okay? That's how we figure out how much we owe Uncle Sam when we sell a piece of property. So, if everybody's got this, let's talk about what an adjusted basis is. That's what's on your slide up here. What is the adjusted basis? Remember, that's what I paid when I bought, right? That's the best definition of that. The adjusted basis is what I paid when I bought. Well, it's more than purchase price. I mean, hell, y'all been doing closing statements now for a week, right? That number, pull out the last closing statement we did, the one we did this morning. The purchase price was $184,650, right? The purchase price was $184,650. If you look at Part B of your closing statement, the top left box is the gross amount due from the borrower, or the total amount due from the borrower. What was that total amount due from the borrower? $194.31, right? Is that more or less than the purchase price? It's a lot more than the purchase price, right? And that's what they actually paid for the property. They didn't pay $184,650 for that property. They actually paid $194,031 because that's how much money it took them to get in the door for that property. Does everybody follow that? So when we talk about this adjusted basis, we're talking about purchase price plus the closing costs. So what is allowable when it comes to these closing costs? Any closing costs not associated with the loan. Anything associated with the loan is the cost of getting the loan, not purchasing the property. So you wouldn't include things like origination fees and discount points. Would you include a survey?
No.
Yeah?
Yeah.
Yeah? Inspections? Absolutely. Termite inspection? Absolutely. Recording fees? Absolutely. If you were the buyer and you had to pay a commission, would you include that? Absolutely. So any expense you pay at closing that doesn't relate to the loan itself is an allowable closing cost.
Where would you include title insurance? Because you could argue both.
Title insurance would be the owner's portion. That's one of the reasons it's broken down into two portions. So it would be whatever portion of the title insurance covered the owner.
So you would not do the loan portion.
You would not do the lender portion, right?
But the other portion you would.
That's right. How about the attorney's fee? Absolutely. That has nothing to do with the loan, right? It has to do with you purchasing the property. So when we say allowable closing costs, what we really mean is any closing costs that we pay as a buyer that's not associated with the loan. That's I think as simple as I can break it down, rather than just listing all that stuff. If it relates to a loan, it's not allowed. If it relates to, in other words, if I was paying cash and I'd still have to pay this amount, it's an allowable closing cost. Simple enough? Once we've added those two together, we're not quite done. We're not quite got to this adjusted basis thing. And by the way, if you haven't already written this formula down, you should. Just because I didn't write it down over here, this needs to go in your notes. Because you can't do this formula if you don't know how to get to this number. What else does it say we're going to add to this calculation? Capital improvements. And Jen has been waiting 6 weeks to ask this question because she's asked it at least 15 times already. And I've said, we'll get there. We'll get there. That's taxes. We'll get there. Is this when I don't count the roof? Now, finally. This is when you don't count the roof, or you do count the roof. Which one is it, Jen?
Count it.
Count it. But only if you're doing what, Jen? I mean, if you're doing what?
Replacing.
If you're replacing it. Here's the difference between a capital improvement and a repair. If I'm fixing something, that's not a capital improvement. If I am replacing it, it is. And so you have to be very careful in these kinds of questions because they'll say things like, you know, Travis bought the house for $185,000 and he paid $3,500 in closing costs and he paid $1,500 in repairs and then he put a new roof on for for $8,000. Well, you're gonna use all those numbers except the
$1,500.
$1,500 in repairs. Those aren't part of the deal here, because they're not capital improvements. Does everybody follow that? So the best rule of thumb with, is it a capital improvement, is, was I replacing something? Is it a new something? Repairing the driveway? No. Replacing the driveway? Yes. Repainting the house? No. Putting new siding on the house? Yes. Cleaning the carpet? No. Replacing the carpet? Yes. Those are capital improvements. And they're going to get added to your purchase price and your closing cost. And once you've added all those things together, then you have your adjusted basis. So let's think about this thing just a little bit. This whole formula over here, what are we spitting out at the end?
Taxes.
Taxes, money we owe to the government, right? In general, unless you're like a masochist or something like that, you want that number to be bigger or smaller? I don't know about you, but I want it to be as small as possible, right? So, if I want the tax to be as small as possible, that means I want the capital gain to be as small as possible, right? And if the way that I get to a capital gain is this minus this, and I want this to be small, which one of these numbers do I want to be small? Which one do I want to be small? The one I'm subtracting or the one I'm subtracting from?
From.
From. I want this number as small as possible, and this number is what?
Big as possible.
As big as possible. So the reason I point that out, I want this number to be as big as possible. What am I doing every time over here? Plus, plus, plus. Plus, plus, plus. Purchase price, plus closing costs, plus capital improvements. Everything for this line is a plus. I want this number big.
If you're not realizing that, you might be realizing that your rental income, which you get taxed at a higher rate, if you're gonna hold the.
Yes. Way too complex for the idea we're doing right now. I mean, that's just so far beyond a capital gains tax discussion. Yes, you're exactly right. There's tons of other taxes that come into play, and I don't want to downplay that. That's where it goes back to that screen that says never give tax advice. That's why we don't even talk about those things. Okay? But from a general standpoint, we want this number to be as big as possible, and this number to, so if this one's all pluses, what's this one gonna be when we start figuring out what goes in here? It's all minuses. What do you think we're gonna start with up here?
Commission.
What do we start with over here?
Sold price.
Purchase price. Purchase price, this is purchase price plus, this is sales price minus. See, you already got it. Simple, right? When it comes to figuring out how to pay taxes, we can all figure out how to cheat the government. That's easy. Make it look like we owe less. Is everybody okay on this slide with the adjusted basis? Good. What? All right, move back. So, I don't have a slide for, I don't know why I don't have a slide for it, but let me write it up here on the board. What is the amount realized? We talked about the adjusted basis. Now let's talk about the amount realized. The amount realized, as I said, it's going to be all minuses. We start with the sales price. When we sell the property. Purchase price when we buy, sales price when we sell. Sales price minus. What's the first thing we added over there? Closing. What do you think the first thing we're going to subtract over here is? Closing costs. That's all for that one. That one's easy.
That's it.
Yeah. Sales price minus closing cost equals amount realized. So what's in these closing costs that's allowable? Commission. It's a big one.
Excess.
Excise taxes. Then closing statements, what else is on this?
Recording, preparation.
Recording, document preparation. Doc fees. What document fee, what recording fee would not be allowed?
Oh, the mortgage.
Cancellation of the mortgage relates to the loan, not to the property, right?
What about you have to pay taxes?
Property taxes would be a deduction on the operating side. That would be a yearly tax deduction. So those would be your closing costs. And there could be any attorney's fees that were associated with the closing. You know, anything basically it took to get that property transferred from seller to buyer that wasn't related to the loan.
Again, so it's not related to a loan, so a wire fee, you can't do that.
If a wire fee is being used to pay off the loan.
Right, okay.
Right.
But the prorated taxes are not.
Right, the prorated tax of the property, the annual property taxes? No. So has everybody got this? So we're trying to make that number as small as we can. We're trying to make that adjusted basis as big as we can. That way the difference between the two, this minus this, small. Because we're gonna pay tax on that one. Is everybody with me so far? Now, let's talk about the ray of sunshine at the end of the dark cloud. Owning your own home. As I said before, most of you will never pay capital gains taxes on your own property. On your own home, anyway. On other properties you will. But on your home, you probably won't. And that is because there is a huge exemption there. The first $250,000 of gain is tax-free for every person in the United States. If you're married filing jointly, you just double it. It's $500,000 in gain. It's tax-free. Not purchase price, not sales price, gain. So that means that number at the end, the one you multiply times 15%, that number would have to be bigger than $250,000 for you to pay any taxes.
Which means it's a very expensive.
Probably be a very expensive property that, or you bought it very, very, very cheap. You know, maybe they've owned it for 40 or 50 years and they paid $50,000 for it and they sell it for $500,000. But even if it's a married couple, even that wouldn't result in a taxable gain. Does everybody follow that?
But those are kind of there for that very purpose,
What's there?
to keep people from having to pay the tax.
Well, yeah, I mean, it's just, again, they've done a lot of these laws are just there to incent people to own their home. I mean, that's the whole purpose of them. And if you think about it, people would be a lot more reluctant to sell and buy something else if they had to pay a bunch of what they profited from one in taxes before they could buy the next one. So that's the thought process behind these kinds of exemptions. So the question is, what is my primary residence? So I can take this exemption as long as it's my primary residence we're talking about. You need to know this definition of a primary residence. Primary residence is any property where you have lived as your home for 2 of the previous 5 years. So they look back over a 5-year period prior to the sale, and if you lived in that property for 2 of those years, collectively, it could be 4 months at a time, 6 months at a time, a straight 2 years through. But for 2, if you can come up with 2 years worth of residency in that property over the previous 5, you can claim it as a primary residence.
So you could have 2 houses, basically.
Yes.
So they want to see like bills, utilities.
Yep.
Mortgage.
Yep.
Which is very easy to pay.
They also don't want to see you filing rental income on it
Sure.
for the period of time you claim it to be your primary residence. And again, the first $250,000 of gain for an individual, or $500,000 if you are married filing jointly, is tax-free on your primary residence. You can use this exemption once every 2 years. Any gain that exceeds $250,000 for a single person or $500,000 for a married person is taxed at the regular long-term rate, but not the whole thing, just the amount above the exemption. So if is that 15%? So if they're married, filing jointly, and they have a $600,000 gain, how much of that's going to be taxed? $100,000 at 15%. So they would pay $15,000 in tax on a $600,000 gain. Okay, is everybody all right on that? Good on the exemption, the exception there. Okay, good. Let's see here. Some of the benefits, tax benefits that we haven't already talked about of selling property. That adjusted basis allows you to cram a lot of things into it that might minimize your gain in that property. And basically any extensive work you do on the property will change the adjusted basis of that property. So that's a big benefit of the tax treatment. We're going to talk about here in just a second something called tax deferred exchanges. All right. Turn in your book to page 434. Tax deferred exchanges. What's deferred mean? Sorry?
Postpone.
Postpone. Delay. Does it mean avoid?
Sure.
Never. Not gonna happen? No. It means delay. Postpone. Postponing what? Paying the taxes. This whole chapter is about real estate, about capital gains taxes. So when we talk about tax deferred exchanges, we're talking about deferring or delaying or postponing paying the capital gains tax. There's a way to do that. The government simply says that if you are willing to reinvest the gain rather than take it, then you don't have to pay the taxes yet. You still got to pay them, but down the road. Now you pay them when you sell the next property. Instead of paying this taxes this time, you pay them the next time when you sell the next property. Unless, of course, you want to do what? Buy again, reinvest again, delay it once again. Now, eventually, you're going to get them because eventually you die. You can't do any more tax deferred exchanges, and there's going to be. So think of it this way. Let's say I invest $50,000 on property. I'm using easy numbers here. We're not going to do anything complicated, just so you can think your way through this. I invest $50,000 on a property. I own it for 5 years, and I sell it and make a $25,000 profit. I would have to pay taxes on that $25,000. It's not my primary residence, right? It's just an investment property, so I have to pay taxes on it. Or I could do what?
Buy another piece of property for $75,000.
Well, I don't even have to buy it for $75,000. I can buy it for $25,000. I'm allowed to remove my original investment if I want.
You make the profits that you make, you reinvest the
Exactly. I have to reinvest the profit.
Like you
The
said,
gain.
So if you buy a $50,000 house cash, sell it for 75, so you make 25, and then you buy a $100,000 house, but you only put in 25,000 because you took a loan.
Right.
And that's.
Loan's going to wash itself out. The loan is going to end up washing itself out. The way the gain is going to be calculated down the road, because presumably you're going to pay off the loan at some point too when you sell. So that's going to get factored into that amount realized when it washes itself out.
So you're saying that the 25,000 on the next purchase, it can be included in the mortgage. It doesn't have to put down 25,000. It can just be realized in that.
You got to put down at least 25,000.
Okay, so it is separate from the mortgage, what you're saying, not. So like if you have a $25,000 capital gains and then you go buy another house and you get a mortgage on it, you have to put that 25 down.
Yes,
It can't be
at
part
least
of
that.
anymore.
At least that amount, unless you want to pay taxes. Whatever amount you didn't put into the next property, you'd have to pay taxes on. Okay? And so now I've rolled into that property. and I bought that one for $100,000, and I sell it for $150,000. Now, what was the gain on the second one? What was the gain on the first one? Now I've got a $75,000 capital gain that I owe taxes on. Unless I want to do what? Invest in another property, and this time I have to invest at least how much? $75,000. So what ended up happening, assuming all these properties continue to escalate in value, and you have a gain on each one of them, you have to invest in ever increasing valued properties, just because you have to invest the gain. The gain gets, and pretty soon you're going to be investing just gain. I mean, the gain will be enough to cut. In fact, 100% of the purchase price will be a gain that you've invested from something else. And all you're doing is delaying paying these taxes. Eventually, they're going to get the taxes. Now that sounds great, and it is. Trust me, many people have made lots of money by doing that. But that 15% rate ain't guaranteed for life, folks. And you're going to be taxed at whatever capital gain rate is in existence when you finally cash out. So you might be deferring a 15% tax now to pay a 25% tax down the road. So you have to keep that into, you kind of have to look at the political waters and see, are they going to keep extending this capital gains tax exemption? Is it always going to be 15%? Are they going to raise it? Because if they do, I'd be better off paying the taxes now than deferring them, right? If they ever do raise the capital gains tax, you'll see such a rash of people selling and cashing out gains just to pay the taxes right now, because they don't want to hold the gain and pay it at a higher rate later on down the road. Okay? Does everybody kind of follow that logic?
And there's also the theory of that too, is if you keep deferring the gain, they're saying we're giving you a chance to make what you owe. So you don't have to come out of your own pocket.
Well, yeah, sure. I mean, it's just the delay tactic. It's a stall tactic. It's completely what it is.
But you're going to make it on that one, so you got to pay it if you want.
Right.
So it's not coming out of your own pocket.
If you want to keep the money, right? It's coming out of what you have left over, right? It gives you less to invest or less to do something with. So, but if you need the cash, whatever amount you take out is going to be taxed. And the way they treat it is when you sell, if you've carried forward a capital gain, the first whatever you take, so say you had that $75,000 capital gain, and you sold a property, and let's say there was $90,000 left over at the end, and you're like, okay, well, $75,000 of this was my gain. I'm going to invest that in the next property. I'm just going to keep this 15. No, first money out gets taxed. That's the way they treat it. So, you have to be conscious of the fact that any money you pull out of that property is going to be immediately taxed at that capital gains rate when you start deferring and pushing them forward. So any money from selling that property.
You can take your initial investment out.
You can take your initial investment out. Yeah. But you may have already done that on the first transaction. After that, then you take out the gain. Okay? Everybody got that? Good. Losses work exactly the opposite of gains. One of the advantages of deferring, capital gains taxes is that you may have a loss on a subsequent property. And if you do, that's going to deduct from the gain you carried forward. If you roll forward a $25,000 gain and you lose $15,000 on the next property, well, that gain, next time when you cash out, you've only got to invest $10,000 because you've lost $15,000 of that gain.
You basically paid it, in their opinion. You paid it where you didn't have to.
Well, you never had it. It
Right.
never materialized, so you didn't have to pay taxes on it. Only $10,000 actually materialized. This much, and I made $10,000. Right. Okay. We also need to talk about profit and loss. I'm going to give you. Don't read your book for profit and loss. God knows that could make anything complicated. Way too complicated. I like simple. So I'm going to give you simple profit and loss questions. Well, I'm not going to give you simple profit and loss questions, but I'm going to give you a simple way to figure them out. What's our favorite handy dandy tool so far with math? T-bar. I'm going to give you a T-bar for profit and loss. dollar profit or loss over rate of profit or loss and original investment. Make sure you put that in your notes. That'll be your savior when it comes to profit and loss. So, Travis purchases a property for $250,000. Five years later, he sells the property, purchase price, sales price. 5 years later, he sells the property for $418,000. I want to know what is his percent or rate of profit on a sale. What's the first thing? Well, first of all, if we're looking for rate of profit or loss, what two numbers do we need? Dollar profit, because this one's a profit, right? We made money. So dollar profit divided by, well, what's my original investment? Go ahead and fill that one in. We know whatever we do here, we're going to be dividing by $250,000 because that's our original investment. Right? Now, how am I going to figure out what my dollar profit is? Subtract those two. 418 minus 250. My dollar profit is $168,000, right? So now T-bar says it's $168,000 divided by $250,000. And what are we calculating here?
Right.
So what do we have to do? Multiply by 100. We got 67% profit.
That's a nice little profit.
Not bad. Let me give you this one. Travis bought a property for $80,000, sold it for $100,000. What's his rate of profit? A, 25%, B, 38%, C, 20%. What is it? A. Don't eyeball it. If you eyeball it, what might you choose? C, 20%, right? He made $20,000, he sold it for $100,000, that's got to be 20%. It's not percent of what he sold it for, it's percent of what he paid for it. And that $20,000 profit is 25% of his original investment. Does everybody see that? Let me give you a lost one. Travis paid $350,000 for a property. He sold it several years later for $320,000. $350. Bought it for $350, sold it for $320. What's my rate of profit or loss? Just write it down. $320. Bought it for $350. Sold it for $320. Let's see here. What we got?
8.6.
Here, 8.6, 8.57. negative, or 8.57% loss. Somebody else got a different number? Good, you all did the right thing. Here's one of the classic mistakes on a loss question. People like to put the big number. In other words, they like to, well actually, the original investment, they like to divide by the small number. Let me put it that way. We tend to think of everything as a profit. We tend to turn it around in our brains, you know. Make sure the number you're dividing by there is always the original price you paid for it. Isn't that an easy way to do profit and loss? Makes it so easy. I mean, so like I said, Travis sold a property with a $50,000 profit, which represented a 27% return on his original investment. Could you tell me what my original investment was?
What was your rate?
27%.
On what, sorry,
What was the first number?
50,000?
I made a $50,000 profit, which represented a 27% return, right?
185, 185.
My original investment was 185, 185.
Yep.
Easy enough, ain't it? Works every time. And here's the great news. We're gonna take a break in just a second. When we come back, we're gonna talk about investment math. It works just as well for investment math too. Terms get more complicated, but the T-bar itself stays the same. Okay? All right, let's take a quick break and we'll come back, we'll do investment math.